Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for September 22nd, 2018. Let's get started as we usually do with a quick week in review. Then we're going to look forward, of course, to next week. And on this video specifically, we're going to look at a couple of long and short opportunities, which I'll show you here in just a couple of minutes inside of the chart segment. So let's start, as I said, with kind of a quick week in review. And with that, the S&Ps close, roughly speaking, all-time high. Dow, all-time high. The Nasdaq happens to be a little bit of the laggard in this week. So looking at markets at all-time high, a lot of market technicians are like, this is it. This is, it's a spectacular breakout. However, I'll counter right up front with the fact that this market is incredibly efficient. And that's one of the first things that I really want to resonate with you in this current marketplace. When I say things are incredibly efficient, all right, everything's fairly humdrum. The market's not paying any attention to news out there. I think we're all fully aware of that. However, there is some big news coming up this next week. We've got FOMC announcement. We'll come to that a little bit later. Nevertheless, when I say the market's incredibly efficient, not doing anything unusual, all we're seeing right now, okay, is this wild sector rotation. There's just no correlation amongst sectors and stocks. It's all of a sudden, this week, later in the week, it was out of technology, and then we have to turn around and buy some of the financials or buy energy, or in this case, later in the week, which drove the Dow to all-time highs, was let's just buy Boeing. And again, that's kind of the only thing unusual, I would say, that we are really seeing. But the market activity itself isn't unusual. In fact, as I said, it's very humdrum. And to kind of quantify that, as many of you guys know, I'm a little bit more of a math geek. I call myself kind of a quantitative trader, better known as a quant. And giving you a little bit of quantitative, analysis to that, if you look at the SPX and the SPX options, right? Now the SPX, it's the mother of all products. It's the S&P 500 index options. Now, not everybody tuning into this necessarily trades options, but the options marketplace over the last 25 weeks. So let's look at just a slice of data from the last 25 weeks. Now, 22 out of the last 25 weeks, we've ended up inside of what we term the expected move. Now, each and every week here on these videos, we talk about these expected moves. Last week, the expected move was just over 30 bucks. This coming week, we have about a $33 expected move, which again, I'll talk about in a couple of moments when we get to the charts. But the point being, the expected move is supposedly a standard deviation. One standard deviation is about 68% of all occurrences. However, in the last 25 weeks, we've had 22 of those 25 weeks inside, okay, of that deviation. I mean, we're looking at an 88%, okay, occurrence rate inside of one deviation, which is absolutely statistically significant. And I believe in 25 weeks, we have more than enough data to kind of encompass that. Now, the interesting part is also that the 3 weeks that we closed outside the expected move, it was negligible. So you're looking at the market right now, you're like, this is just getting ridiculous or breaking to all-time highs, right? This is a challenging environment for a trader. Traders like two-sided markets. We like both buyers and sellers. Okay. For those of you, though, if you're just sitting there and you're like, I'm a buy and hold, okay, even the buy and hold, they're having a challenging time right now because of these wild sector rotations. And many of you are noticing that your portfolios, okay, if you're a buy and hold kind of individual, your portfolios are not producing great returns. Okay. In fact, most of the portfolios are drastically underperforming, even if you just went out and bought the spiders. The spiders are outperforming, okay, mass amounts of portfolio managers right now, or 401ks and mutual fund managers, simply because of this kind of wild sector rotation. Again, if you asked anybody, 2 months ago, you're like, you have to buy Amazon, until the last couple of weeks where Amazon's, backing off back to the 1900 level. That's just one specific example. And all of a sudden, Boeing becomes the greatest thing on the planet to own again. So that, again, is where we really stand. Sector rotations, just pushing capital. When you're looking at the markets appreciating to all-time highs and you're thinking to yourself, where is this money coming from? You don't have to think that hard. It's stock buybacks, and the stock buybacks, okay, have been fairly consistent. It doesn't take that much capital shoved into individual stocks like an Apple or like a Boeing or a couple of the, for instance, financial stocks this week. It doesn't take much to push indices, okay, to all-time highs when you don't have a lot, okay, of two-sided trade. But the sector rotations absolutely keep me on the edge of the seat. Now, in a couple of moments when we come over to the charts, and specifically we're going to get into this kind of expected move discussion. So we talked about 22 of the last 25 weeks. So you feeling like taking a little bit of trade on this? Because when we do break the expected move, it could be quite spectacular. We'll show you a couple of trade ideas for that. Now, this next week of trade holds a lot of promise for a lot of movement, a bit more volatility. Why? First of all, we've got end of the quarter. It's it. September, okay, which is supposedly what in the last 10 years the most volatile month. This hasn't been a very volatile September. Well, maybe we can hope for a little more volatility this next week. However, we have the end of the quarter. We have an FOMC announcement. I don't think anybody's expecting anything unusual out of the FOMC. What are they going to do? They're going to raise rates, okay? But when they're going to discuss these rates and when they come out with the statement, that's when I believe that interest rate fears could really start to resurface. And they should, okay? Rightfully so. Rates on the 10-year right now haven't sustained, okay, the level above 3% since all the way back to 2011. So rates right now are higher on the 10-year, okay, at any point since 2011. And that is therein lies opportunity. And in just a moment here, we're going to get to the charts. We're going to show you some opportunities. I mean, where do opportunities lie right now? And we're going to get to both long and short opportunities. With that, let's get to the charts. To the charts we go. There's an irony, the quantitative trader displaying charts. Nevertheless, I couldn't think of a better way necessarily to display kind of some of this, data to you than to elaborate upon it using a chart. With that, I was talking a moment ago about the SPX and the last 25 weeks. And those last 25 weeks, that kicks off right here, right in the beginning of April and extends, of course, into really this most recent week of trade. And we've had 1, 2, 3 breaches. So you got 22 out of the last 25 weeks inside the expected move, which comes out to 88% of the time. Nevertheless, a 1 standard deviation move is supposed to occur 68% of the time. Like that, a little tail risk in there. But it's supposed to occur 68% of the time. So the one thing that I want to remind you of, and some people, you're listening to this and maybe you have a little bit of a mathematical background, maybe an engineering background, the marketplace, okay, is moving from these periods of an incredible inefficiency, which was earlier this year, where you can see breach after breach after breach after breach after breach. Okay, I mean, I can go all day over here. This was actually record-breaking number of breaches of expected move. That effectively means that the marketplace is doing a horrific job of pricing options. All of a sudden, we snap, and we snap back to an incredible period of efficiency. And this is where I kind of counter when people are like, this is just, astounding, a breakout to the upside. There's no breakout. There's no nothing. Right now, okay, we're doing what the market is anticipating us to do. Now, as a trader, I don't much love this because it's a one-sided marketplace. One-sided marketplace, meaning, we buy, we grind a little higher, grind a little higher. That isn't exactly the excitement that you're looking for as an options trader. Nevertheless, you have to pretty much, give whatever the market's going to throw at you and turn it into something. And that's exactly what we're going to do here momentarily as we look at a couple of opportunities in terms of trades and or investments, which again, I'll bring to you here momentarily. The point that I wanted to make on these SPX expected moves is you start thinking to yourself, and it's fair to think this way, you got what? 22 out of the last 25 weeks inside the expected move, okay? I mean, we're what? You're thinking we're probably overdue for some wild and woolly, what we kind of call the 3 sigma type move. A 3 sigma move was like 3 times the standard deviation. Well, this next week, we have about a $33 expected move, right? $33 higher, $33 lower. And that's what we're looking for this next week. Still a lot of news out there, right? You've got the FOMC, you've got some GDP, there's some more, durable goods data. I can go on and on and on, but everything that's coming out this week, and yet there's only a $33 expected move. First of all, if you're trading on an intraday basis, well, you know what? Let me show you this, okay? On an intraday basis, you can cruise over to the SPX. If you're comfortable with the SPX, that's all well and good. If you're not comfortable with the SPX, listen, go to the spiders. Okay, a kinder, gentler, softer place to be able to do business. But when you start looking at the spiders, you've got an expiration now in the spiders on a Monday. You've got a Wednesday. Okay, you got a Friday. And the interesting thing about the Friday one is this Friday expiration also falls as the quarterly expiration. And if you're going to trade on an intraday basis, look how low some of these implied volatilities happen to be. It's quite staggering when you think about it. And again, the implied volatility of the at-the-money options throughout the course of the week, okay, tells me, again, this week, I'll be a net buyer of premium. I'm going to be buying some options throughout the course of the week. You're like, why would you want to do that? I don't know, 6.8% implied volatility, okay? If nothing happens, so be it. Okay, but if something happens, let me tell you, I want to be a buyer of 6% implied volatility because I've seen 6% go up to 20% in no time at all. And with options, I mean, you got to recognize like this is the Wednesday expiration, right? Okay. These options right here, what are we at? 292? The options that are literally at the money are trading for $1. Whether it's the calls or the puts, they're trading for $1. And that's a full 3 days. It's crazy low. It's just crazy low, and that is opportunistic. But again, that's on an intraday basis, okay? On an intraday basis, you buy an option, and what do? You just hope, okay, for a breach of that like day-to-day expected move. But on the outside of this, I'm also placing what we term risk twist spreads. And what a risk twist spread is, for those of you that do not know, it's a kind of a wild and woolly out of the money put spread, okay, in a ratio, looking for one of these large, what we call 3 sigma moves to the downside. And we've been placing some risk twist spreads. We've got our risk twist spreads on. They're actually good all the way out into December right now. Why do we have them on? Just in case we get one of those. Because again, when you look at something, you're like, well, 22 out of the last 25 weeks have been an incredibly efficient marketplace. Let's see a little irreverence. Let's see a little inefficiency. Okay, let's look for Mr. Toad's wild ride to show back up. And if that does occur, we're going to be positioned very, very nicely for it. So as I said, this next week is going to be filled, okay, just filled with events. So on Wednesday, and again, the reason I was just pointing out the Wednesday implied volatility, well, there's a method to the madness. That low implied volatility of 6.88% of those puts, that's with an FOMC announcement coming out, right? And Jerome Powell, JP, is even going to have a press conference on top of it. By the way, whenever he does a press conference, that pretty much means like it's a done deal, right? They're going to raise rates, but he could change some of the rhetoric around it. And that's my own opinion. The rhetoric that he's going to change this Wednesday is going to resurface interest rate fears, okay? Which brings me to the point of this entire video. Interest rate fears. So let's cruise over to the TNX, right? Right now, I don't even want to worry about individual underlyings. All we're seeing, okay, is just what? Hide the money, sector rotation, hide the money, sector rotation. It's a party, okay? We are trading, and trading is trying to negotiate like, okay, what sector is going to be in favor, what sector is going to be out of favor. But right now, I'm going to show you larger opportunities that I believe exist in the marketplace, and a lot of them are very interest rate sensitive opportunities. Okay, because that's where I see where a lot of traders can get some edge right here, right now. First and foremost, big statement that I made a moment ago in the video portion was this, okay, the rates, they haven't really sustained this level, that's where we are right now, above 3% since all the way back until what? You got to go back to mid-2011. And what we're looking at right now is the TNX, that's the 10-year weekly. Okay, that's the 10-year. The 10-year is important. It is important because that's the one that all your mortgages are based on. Even when you have like a 30-year mortgage, everybody's like, well, I have a 30-year mortgage. Well, yeah, but the banks are still basing that off of the 10-year because they package your 30-year mortgage, they, ship it off and sell it, okay? And most of that is offloaded into the 10-year. So nevertheless, the 10-year holds incredible importance, and the 10-year has picked up a little bit. But the 10-year is only part of the picture, okay? The 10-year is all well and good, but here's the 2-year. Now, this is the 2-year, the actual Treasury note itself, and this is just fully tanking. And I want to come in here and I want to do it's a futures contract, so you have to adjust for contract changes, hit apply, hit OK, and it is absolutely tanking. So the short duration rates are really, really picking up. And those short duration rates, this can impact trading firms. The cost of carry, the cost of holding on to positions becomes substantial right now. I mean, for the first time in a long time, options traders, we're going to have to start talking about RO. You know what RO is? It's the effective interest rates upon your option. Okay? There's going to be some RO risk. I haven't talked about RO, and it's literally been 10 years since I've even brought up, RO. Been in this business for 20 years. Half of my career, there has been no RO. So, yeah, I guess the statement of the day is RO. We'll talk about that later this week. But the 2-year is coming off hard and fast. And this is going to have a lot of impact for carry costs, businesses, any short-term financing. Okay. The upside of it is, hey, you can actually get money in your bank account based on interest. It's a novel idea that we haven't seen in the last 10 years. But what opportunities do I see in here? Okay, we're going to cover a few longs and a few shorts. All right, let's get right to it. One of the positions that I'm going to reiterate here, okay, this is both a longer term and a shorter term position, is the XRT. Now, the XRT happens to be the ETF specific. It's the retail sector. In a rising interest rate environment, you would expect there to be what? It would impede at least a little bit of retail. Even the slightest hint, okay, isn't visible anywhere on this chart. Now, I, as a trader, do not make decisions based on looking at just one single chart. Everything I do has relationships to it. In this particular circumstance, all right, we've been in an incredibly strong dollar environment. There's interest rate headwinds, and yet retail continues to climb. It's, again, a matter of there's capital trying to find a home, and this is the home that it's ultimately found. I don't think it really goes any further than that because it's almost impossible to make a fundamental argument for the XRT at this moment in time in a rising rate environment, no matter how strong that you think the economy might be, okay? Which, again, is arguable because there's no wage increase coming, right? There's no wage increase, and people are looking at that like, well, jobless, right? Companies are booming. Corporate America is making a ton of money. Not arguing any of that. But in a rising interest rate environment where the wage, okay, isn't really moving, then you got yourself an issue. And the XRT is kind of the object of my affection on this particular front. Now, I am sustaining short positions in here. And I've got in-out spreads, short positions. It's an absolute party. If you were to say to me right now, Don, I want to enter into a couple of positions on the XRT, the position that I would look for here that I think will probably offer the best payout, the best risk reward would be to buy in the money puts and create a synthetic short position. In this case, I'm going to about an 89 delta here on the 55 puts. Now you can see I've already got positions in the 20-day, the 27-day, and I'm rolling out a bunch of positions. We're deep in the money over here, all right? So the XRT, I wanted to reiterate that position, but it's also important to denote the XRT. This is not like something I'm going to hold overnight or hold for a couple of weeks. I'm in this one, okay? This is, if you will, an investment to the downside. I don't think it's fair on these weekend videos to throw a ton of stuff at you and expect you to pick up all these different trades. This one is more an investment, again, to the downside. Now, I'm also going to bring up some long positions here momentarily, but I wanted to start with the XRT. The next one, okay? Huge opportunity, short Boeing. Boeing has also been the object of my affection. Now, I have maintained short positions in Boeing, okay, since very early on in the year. Has it worked? This has been, okay, kind of the bane of my trading existence. It hasn't worked, but some of the rolls have brought in, okay, excellent credits, meaning, I was short up here. I wasn't able to roll. I was getting killed. We came down. I rolled over here, took a nice credit. We rallied back up. Okay. This has just been a back and forth. And it's been a little bit of a cluster for me in terms of trades. But I will reiterate the stance in Boeing. If the market, okay, turns around as a whole, Boeing is the underlying you want to be in. Now, Boeing isn't so much of an interest rate play. Boeing is direct play, okay, to short the Dow. You're like, why not short the Dow? Because I believe that Boeing is going to offer, okay, the best risk reward on this front. Like Boeing is going to be spectacular when it comes in, much more so than the Dow. What's the downside of Boeing? Hell, it's a $370 product that's kind of expensive to trade, and I have to go deep in the money, and I bought deep in the money puts over here, the 410s. Right, the 410 puts all the way out in November. So I've got to sweat on that position a little bit. Here's another one that's also interest rate sensitive. Okay, another short position before I bring up the longs. Home Depot. Okay, Home Depot. I like it a lot. All right, pretty much right at its all-time high is Home Depot. Here's another one that, again, very, very similar to the XRT, but Home Depot could offer really stupendous, okay, kind of risk reward in terms of the fact that it's Home Depot. Come on, it's up 13% on a year-to-date basis. Obviously, the storms recently surged the product to all-time highs, and that's actually one of the reasons I'm bringing it up in this weekend's video. Again, this is a position to be sustained over a longer period of time. Next one on the list happens to be Ford. Ford is a long take. Now, I am long Ford. I am long Ford by the means of having sold, okay, a number of puts in here, and I'm maintaining also a substantial stock position inside of a separate account. So I'm both buying stocks and selling puts inside of Ford. Okay, it's still there for the taking. I don't necessarily believe that this rally is going to hold. Ford may still come in. Okay, nevertheless, they are flushed, okay, with cash. They're not doing stock buybacks like a lot of the other firms. The reason I like Ford is when you start moving out of what's been in favor. Okay, tech's been in favor, and the Boeings have been in favor, and I mean I can go on and on. Even lately, Caterpillar's been in favor with the marketplace. When they start moving out, okay, of the favorites, they'll start moving back into companies that have been fiscally responsible. Imagine that. Granted, there's a little bit of a pension issue inside of Ford. Nevertheless, on a longer term play over here, okay, they actually have cash in the books. They haven't been doing stock buybacks, and I like it. And I like it for the reasoning of the marketplace will rotate into a product like Ford when they're done with everything else. In fact, okay, you can make an argument. That's actually what we've seen in the last 2 weeks. When I say they're done with everything else, Apple doesn't look so good. Okay, Google doesn't look so good. All of a sudden, Ford, right? Remember, I don't ever look at one chart and decide anything looking at one chart. Another one that I really like, okay, in a rising interest rate environment, silver. Now, silver, this is one that you're going to have to just buy, close your eyes, pack away on the side, put it in an IRA. Maybe you get a 20-30% return out of it, but it's going to take some time. Silver, if you actually can open this up over 10 years, all right, we're pretty much bottom of the barrel inside of silver. You got to go all the way back in time, right? It was a brief moment back here, 2015. By the way, we actually purchased it back here as well and sold it when it crested back above 15. Nevertheless, one of the best opportunities in silver that you've seen inside of over a decade, people. That's really what I wanted to do in this weekend's update. I wanted to give you a couple of opportunities. Remember, these are not short duration opportunities. Those short duration trade opportunities I discuss all day, every day on TheoTrade and in the chat room. These are longer duration takes, okay, based on a rising interest rate environment that that's just not going to go away. The Fed is what? They're contracting the balance sheet and raising rates. What are they trying to do? Slam the brakes on the economy. Why? Things can't get too heated up. Can't possibly have inflation. Meanwhile,
wage growth has been negligible. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.